Welcome to Money on Tap, your personal finance headquarters. Money on Tap is where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this radio show. We look at all sides of the issues and bring a fully independent planning perspective to the table. My name is Seth Krussman, and I'm joined here once again with John Ryder and Ben Brayshaw. Good morning, you guys.
Good morning, Seth and John.
It is a good morning, and Ben, it's good to see that you're greeting me this morning. So, good morning to you, my friend.
Yeah.
Wow, it's incredible what just 1 week will do.
I know it
John
was
no longer.
Last week we were unfriendly. Just a lot of fighting going on. I don't know what's going on, but today it's all good. It's all good.
I don't believe you. I think that's the first time you've ever lied to me, John.
Yes. That's what you think. That's what you think. That's good.
Hey, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook /3D Investing and Twitter. BFG stands for Brayshaw Financial Group. It's BFG_LLC at Twitter. Today, we want to spend some time talking about, well, guess what? A problem.
Why are we talking about problems, Seth? Because there's problems out there, I guess.
Well, you know what? To be in solution mode, which we are all the time, there needs to be a problem, doesn't there?
There is, and there seems like there's no shortage of it when it comes to our lives with different things. But I think it's a very timely topic that we're looking at today, and that's really the problem of that seniors have. And actually, maybe
it's not a secret.
It's not a secret. No,
it's not a secret.
It's a fact that many people out there don't realize that they have a cost out there coming to them that they don't realize yet, and maybe some people are right in the middle of it where they do. But that's the cost of what would happen if I had to have long-term care, and I needed someone to come in and help me at my house to be able to just do the daily living activities.
Well, yeah, I mean, people are living out there with the idea that this is a Mount Everest that they can't deal with or climb, and they're just, I mean, there's a good majority of people out there pushing this, this down the road and saying, "I'll deal with it later." And then it's a problem.
Yeah, and so we're talking about the senior generation here is growing, Seth, and I'll let you cut it in just a second, Seth. But the problem is we have 10,000 people a day, more than that are turning 65. That's a lot of birthday candles. And the fact is that this is going to continue for the next 10, 15, 20 years.
Are you recommending that I buy into birthday candle companies?
Yes, I am. Yes. So we'll be giving some recommendations at the end of the show. But the fact is, there is a problem out there. And so we're going to spend the majority of our time on this show talking about the problem. And we're going to talk really about how to address some of those problems in the following show. But before we get into that, before we get into talking about this problem out there, it's time for Money in the News. So Money in the News is that time of the show where we highlight some of the headlines that have been hitting the news that have to do with money. So, it's not often that we find positive news out there when it comes to athletes and money. I don't know. I feel like every time it's like rappers and money. I hate to destroy your integrity.
Well, that seems kind of stereotyping there, John.
Wow.
I'm like, who can't enjoy a good rapper that can be financially responsible?
Okay. So I just don't hear about that often. And often when it comes to athletes, I don't know. I feel like I always hear about the athlete that made his millions of dollars back a few years ago, and now he's looking for a job doing anything because he's just kind of gone through it. And the fact is, professional athletes just don't have a great reputation for saving the money, for investing the money.
Really?
That's just how it works. And it's just how it works. But today we want to talk about one of our local athletes. And Ben, why don't you bring it around?
I am very excited to mention Rob Gronkowski, who is our kind of hero of the day in the financial world. I think we're going to just...
and on the field, too.
On the field,
yes.
Absolutely. And as long as he stays healthy this year, maybe we have another shot at it, right?
There you go.
But, you're right, John. I mean, there is constantly this kind of stardom, financial crisis, combination that comes together, pretty often in our world. So to be able to earmark somebody as well known as Rob Gronkowski, who is a person who has, showed good talent on the field, strong standards financially that we're going to go through, and has been a community guy on top of that. I mean, there's a kind of a win-win-win here that I am pretty proud of to say is from New England.
Yeah, have you ever heard of Rob Gronkowski there, Seth?
Well, yes.
I'm trying to think of the local Oregon team out there.
I have heard of Rob Gronkowski.
What's your professional team out there?
Do you have one?
No, I'm trying to think.
In Portland, Oregon, we have the Trailblazers and the Timbers. Those are our professional teams.
But what's your football team?
The Seattle Seahawks would have to be. Yeah.
Okay. Well, I guess. All right. Yeah. So you have heard of Rob Gronkowski, right?
Yes, I've heard of. Yes, I'm pretty sure.
Superstar.
Yeah.
I actually call him Gronk.
Okay, so this guy earned $10.5 million last season, including a $2.5 million bonus for being named All-Pro. 5th time in his career that Gronk has achieved that honor. But he hasn't spent a penny of his contract money from last season. In fact, he says he hasn't touched any of his career NFL earnings, including the 6-year, $54 million contract he signed in 2012. What is this poor guy doing? Is he like on the streets because he hasn't spent any of his money? Well, the fact is he has lots of endorsements.
Well, that's the thing. I mean, he's made a decision, and I think, everyone budgets the way they budget. I found that people either budget poorly or they budget well, right? So, but everyone has a budget. It's just like either spend it all or don't.
Some people say they don't have a budget, but they do.
They do. And, Gronk has decided, hey, I'm going to save all my money from, my earnings with the Patriots, and I'm going to spend my contract money for all the, in-person performances or whatever he's doing, the Dunkin' Donuts stuff and all the different things that he's doing. He's spending those dollars.
Yeah.
But even that he's saving some of it. So.
Yeah, he says this. He says, I live off of my marketing money and haven't blown it on any big money, expensive cars, expensive jewelry, or tattoos, and still wear my favorite pair of jeans from high school, which is, I think, kind of funny. Come on.
No, that's
the guy's still wearing his favorite jeans from high school. Is there something wrong there?
Well, I gotta find out what the brand name is, because I'm gonna start outfitting my kids in those. They just apparently never wear out.
I know. Hey, so he was just on this show. It was called as a video series called Kneading Dough, and you guys got the spelling of it's kind of funny. It's Kneading dough, obviously like bread. And he said that he still lives by the same code, spending only the money he earns from endorsement deals with Dunkin' Donuts, Nike, Body Armor, which I'm sure is a lot of money. Okay, so let's not say he's only getting paid $20,000 a year for endorsements. We all know that's a lot more than that. But he says instead of blowing his money, he's been investing. He's happy with the results. He said this. He says, "If you see my NFL money, how much I've made, I've got way more than that, baby," said Gronkowski. So obviously he's saving. He's doing all right.
So he's saving above and beyond the Patriots money. He's saving some of the endorsement money as well.
Exactly. So he's got tens of millions of dollars now. But it's funny because he was asked, Seth, in the broadcast, in the video series, he said, "Hey, what kind of stuff are you looking? I know you're not spending money now, but are you looking at some things that you'd like to spend money in the future?" And he says, "Well, yeah, I like jets. I know they're expensive, and I'm saving for a jet, but I like jets." But then they kind of pressed him a little harder. Okay, what else? He says, "Well," I thought this was kind of funny. He says, "I've never really had jewelry in my life, but after borrowing jewelry from a friend of mine, a chain, a necklace, I guess, he relented and he purchased one for himself. He said, it's been 8 years. I haven't really bought anything in my career. At one point, about a year ago, it was reported that he and his brothers had run up a large casino tab. But Gronkowski, who prides himself on being the opposite of a spendthrift, said the reports simply weren't true, and they'd sooner donate that $100,000 to charity rather than blow it on drinks. I think he does have kind of a partying persona here. Yes, well put, Ben. But yeah, so
yeah. There's some video clips of Gronk out there,
yes,
getting down.
Sure.
I think when he broke his arm and had it in a cast, there was some publicity about that.
Yes.
I'm sure wherever he goes, probably the bill's getting covered. Him being in some environment probably brings more people in the door, and the owners are just super happy to have him there. But the lovable knucklehead persona of Gronk and this, super saver, I think it's fantastic. I think that's awesome. It just shows, hey, we did a no judgment zone last week, right?
Yes.
We're not going to judge you, Gronk, here at Money on Tap for what other people are saying out there. And we're super excited to find out that you are a saver and that you've taken your streams of income and you've you've said, hey, this over here, I'm going to set that aside, and that's going to be my savings. I'm just going to live off of this stream of income over here, which is substantial, right? Like you said, it's not 20 grand a year that he's trying to pull himself back into this place, living in the duplex over here,
or a van down by the river. I don't know, not that either.
He's not pulling a Seth over here. Let's just say that.
Hey, let me just tell you this, though. This is kind of cool. We should probably ask Gronk to be on our show because guess what? He's kind of getting your reputation on the Patriots for being kind of like a financial advisor per se. So Ben, what was the deal? Something about a Hummer or something that a buddy of his wanted to buy?
Yeah, so I think this is cool. I'm glad he's like stepping up and kind of mentoring some of these guys because this one guy came to him and said, hey, listen, I'm thinking about buying a Hummer.
This is a player on the team, right?
Yeah, I'm thinking about buying a Hummer for like 22 grand, and he's like, well, what are you doing for transportation now? He goes, well, I'm renting a car for $400 a week. It's like $1,600 a month. And Gronk's like, buy the Hummer. But I mean, he didn't even take any time to really... I mean, it was just so apparently obvious to him, which says, there's a lot to Gronk that he is probably so misunderstood.
Yeah, he says I was like, dog, hurry up and buy that Hummer. So I think it's kind of fun. It's amazing to me though. This is a player that had been playing for I guess a year, but this guy was asking him, hey, what should I do? And so 22,000 is kind of funny because it's not, he said it's not like you're going to go out and buy one for 120,000, but hey, it's $22,000. I think you can do that, So hey, it's not going to set you too far back.
Props to the new guy for reaching his hand out and saying, "What should I do?" Because that's what we just talked about that last week. I mean, that's really one of the main reasons that we're here is because we love when people reach their hand out and say, "Hey, what should I do in this situation?" And I think there's the idea that we're going to say, don't spend money, no matter what, right? And that's not it. It's about how do we position ourselves? Maybe the dollars that we're spending would ultimately be a huge savings in the difference of what we're doing right now.
Yeah, and I mean, I think ultimately, it's interesting. Here's a guy who's spending $1,600 on a vehicle for a rental, right? And he's looking at a $22,000, obviously used Hummer, which is good thinking anyways. I'm not going to buy something brand new and expensive, but he didn't even understand the correlation. Like he hadn't done any math. He thought he was probably paying a reasonable sum renting.
Yeah, it's funny too. The guy that asked about the Hummer, he was actually saying, hey, I mean, I know it doesn't get good gas mileage. Should I still get the car? Which is kind of funny. Gronk said, no, I think you can handle gas on it. That's not going to be a problem.
Yeah.
So, hey guys, second story in Money in the News. It seems
two
like
positive stories this week.
This is a positive one. This is certainly a positive one. And this is just about the climate that's out there when it comes to small businesses. Now, Ben, Seth, we have a number of small business owners out there. I'm thinking of one just recently that just switched over to a startup in Boston. He's doing really, really well. He's hiring employees like crazy. And the fact is that small businesses out there are starting to take off. And the optimism from what we're reading here is at an all-time high. So there's a NFIB Small Business Optimism Index that it marked its second highest level on the survey's 45-year history at 107.9, rising to within 0.1 point of the July 1983 record high of 108. So people out there, small business owners, are thinking, hey, we're creating a product. It's a product that people want to buy, and people are lining up out the door to buy this product. And it's happening across the country. And that's exciting.
Yeah, there's a lot of optimism. I mean, I think that's where, the Jobs Act, all the stuff that's going on in our country economically. I mean, people have seen an increase in their paychecks just by some of the tax cuts and so forth. I mean, there is a lot of positives. I mean, just even some of the deductions on autos that, the weight limits of cars was reduced for better upfront write-offs for small businesses. There's been a lot of effort to try to stimulate that space and give the small business an opportunity to have some success and the growth years it needs to create stability. And I think that's what we're seeing inside this index and the calculation there.
Yeah, there's some different factors that are highlighted here that I think are pretty interesting. It says this here: July is the 8th consecutive strong month of reported sales gains after years of lower negative numbers. A net 35% of owners expect better business conditions, ticking up 2 points from June. So here's some of the highlights. The percent of owners citing the availability of qualified workers as their number one business problem landed 1 point below the record high. And another one, reports of compensation increases remain strong, which is terrific. Capital spending maintained a respectable place, but did not display the exuberance of its fellow indicators, although spending plans did post a gain. But I think this is the next one is kind of a key one. Plans to add to inventory holdings were strong as strong sales continued to deplete stock. So the fact is that people out there, they need to supply the goods out there, and they don't have a problem with filling up that inventory because they see that they're going to be sold.
Well, some of the recessionary events were due to the heavy inventory standards that companies maintained.
Sure. So not the just in time.
Right. So it used to be like, okay, we'll keep all this stuff so that we can meet that on demand kind of service thing. Mm-hmm. Working with a school that I have worked with for years and years, we were looking at bleachers, mm-hmm. and we talked to them about that, and they're like, "Well, we have to build them from scratch." Mm-hmm. And I'm like, "What do you mean?" Well, we don't do inventory anymore. That was
they don't keep it around, yeah.
Because it's like even though we have that, we have to pay for warehouse space. We have to, we've already paid for all the material that built them. It may not be exactly what someone wants, so we may have to go to building it anyways. And honestly, we just tell people that's the way we are, and we make the best bleachers in the world. Yeah. Is how they touted it. Fair enough, but they survived the recession.
Yeah.
And they've learned there. And I think a lot of companies have realized that warehouse space doesn't make a lot of sense unless you're Amazon.
Yeah. Of course, they make you wait too, though. They make you wait. So you had a long waiting period, and you could have said, you know what? I don't want to wait. We have opening games coming up here. I want to be able to take advantage. So that you could have gone somewhere else, I guess. Correct?
Yeah, we could have, but I think this is where, and they're not a small business, but I think that's what our business economy has learned is that, there's times when, you have to warehouse. I mean, it's kind of like need versus want and understanding the differences. And I mean, some things you're going to have to warehouse, like they're just going to need to warehouse steel, but that doesn't mean that they have to warehouse the bleacher finished.
Right.
Yeah, I think it's interesting, the hiring that is starting to kind of decrease. There's 88% of those hiring or trying to hire reported few or no qualified applicants for the positions they were trying to fill. And I don't know if you've reached out to try to have any projects done around the house lately. It can be a little challenging to get somebody to show up for that call. And I think that's another, just like the experience indicator. What is that? What's that index out there? Are you trying to call a contractor and get something done? Are they showing up? No. Economy's rolling.
That's exactly my experience. No. So true. So true.
It is tough. It's tough.
Hey, we're going to take a break here at Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Hello, my name is John Ryder, a partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. 10,000 Americans are turning 65 every day, and planning a successful retirement today is more challenging than ever, with a roller coaster stock market, political and economic uncertainty, and so many unknowns when it comes to the escalating costs of healthcare. Let us show you how we utilize the 3D method of investing, utilizing insurance, brokerage, and fee-based planning. Using our experience, let us help you plan for a successful retirement. Now is the right time to start getting help. Give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices across the country. We would love the opportunity to meet with you. There's absolutely no cost or obligation to meet with us, and we welcome you to our offices. Call 855-226-8551 today.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, bringing out professionals, experience, and some fun in three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. So the title of our show is The Titanic. Is that right? No, it's not. It's the long-term healthcare costs and a problem that is not going away. If you are over the age of 50 and you've done a good job of saving for your retirement, then you'll really want to check out long-term care and the potential problem of long-term care and the impact that it may have on your portfolio. And, John, you were talking about earlier, people kind of pushing back, talking about this, having a conversation, taking a look at what the solutions might be. And I immediately think you are rolling the dice, folks. You are. And one of the things about gambling that now I'm not a gambler. Don't go to the casino. Been in there before. It just doesn't hold my attention or interest. Thank you. I'm grateful that one didn't beset me. But there's this saying that the house always wins.
Yeah.
And if that's the perspective, if that's what's going on, the likelihood, the statistics of needing long-term care is an ever-rising statistic.
Absolutely.
In our world today.
We're going to get into that. We're going to talk a little bit about the costs. Again, this show is really going to be centered more around the problem of long-term care. I think we want people to understand, we have plenty of people. We have a lot of people. I'd say the great majority of people that come into our office are around 45, 50, 55 years old, somewhere in that arena. They're starting to think about the future. But are they thinking about long-term care? No, they're healthy. They're doing great. But you know what they may have done? They may have done a great job of saving. They may have $400,000, $500,000, $700,000 saved up, maybe more, maybe less. But the fact is they're not thinking at all about, well, what could happen to those savings. And before we get into the down and dirty on that, what I do want to spend some time talking about is really the tsunami that we all have coming towards us when we take a look at really where we are in our country as far as people turning 65, people hitting that retirement age. As I mentioned earlier, we have over 10,000 people a day that are turning 65. And we have this great wave coming at us that we don't even get. In fact, Ben, I know we talk a lot about this when we're talking with people about their portfolios and how to position their portfolios. Because we're talking about, well, what asset classes do you want to be in? Do you want to be in large cap, small cap? Do you want to be in mid cap? Do you want to be in real estate? We talk about a lot of these different things, and we're talking about maybe how they should be positioned in their portfolio based upon what's happening in the country as a whole. But we're also talking about how people should protect their portfolios because there is this tsunami coming of people turning 65, and there's age-related issues going on. So let's talk a little bit about that, and let's talk about kind of the changing demographic that we are seeing here in America today.
Yeah, no, I mean, we do talk about that a lot. We have 320 million Americans. We talk about that pretty regularly. Yep. And, we've got, 30 to 40 million of them that are retired essentially right now. We have another 80, 90
what
million.
Is that, 5-6% somewhere?
Well, that's going to be, almost, 10%.
Yeah.
And then we've got another 80 to 90 million Americans going over 65, which is under current population about almost 40% of America that's going to be retired in the next 20 years.
Say that again.
40%.
Okay, so 40% of our current population is going to be retired in the next
20 years, which makes, Seth's comment of like finding someone to help around the house, more problematic 20 years from now. I mean, it's ultimately like get all your stuff done now because 20 years from now, you're not going to have anyone to do it.
Yeah.
So there's, and that's not including birth rates and stuff like that. We're just talking about current population, how many people would be retired. And, we talk about that from an investment standpoint all the time because it makes a lot of sense to say, well, how are those people going to invest 20 years from now? And how should you be adjusting your portfolio today to meet the demand of tomorrow? Because investments, care, long-term care, all that stuff, it is a competition. It is not a race. And it's something that you either are prepared for beforehand and you beat everyone, or you're not prepared. And, we try to educate our clients on that because the cost of it can be very manageable most of the time if done correctly and handled properly. But if you wait or you delay, you create potentially financial struggles that might be more difficult to overcome.
Okay. So people in their 50s don't necessarily want to talk about long-term care because, again, they're healthy, they're feeling good, they're doing a good job saving in their portfolio. But long-term care really is a phrase that kind of encapsulates many different options. It could be home care. It could be nursing home care. It could be assisted living, and even moving in with family. Again, that's no one wants to think about that at age 50, 55.
But you know what, John? The thing is when they're not thinking about that, right? The thought is I have a choice. Like people think, well, one day I'll just buy long-term care and I'll just go to the nursing home if they need to take care of me, or the assisted living facility, or I'll stay at home. or whatever. But
or Medicaid,
Yeah.
Medicaid will take care of me.
But the truth is that there's not enough beds in America right now to service the number of people retired today. Nevertheless, the other 80 or 90 million coming.
Of course, they're building these like crazy. I mean, they're building them all around. New Hampshire, they're building them all around.
Yeah. And what ends up happening is you may have, someone might buy legitimate long-term care insurance, be insured up to the hilt.
Yeah.
But that doesn't mean that there'll be a bed that you can purchase.
Yeah.
That's a scary factor.
Also, there's another factor there that some people don't really maybe don't understand. And there's a regional supply and demand. Like, for instance, here in the Portland metropolitan area, we may have enough beds, right? But if you go over to Baker City, the Eastern Oregon, almost Boise area, there's just nothing available. There's no facilities. I mean, people in those rural areas really are having to travel to much larger metropolitan areas to be able to find those situations that will work, and those are limited.
So that's absolutely true. One of the things I think people out there think is that Medicare will cover some or all of the expenses for nursing home stays for those seniors who qualify. But the fact is they're only going to cover it for a limited time, and that really leaves people in a very, very bad situation as far as paying.
It boils down to the family. And is the family there to support? Do they have room, or do the capacity to care for?
Do you guys find that? So when you talk about Medicare, right, and then there's Medicaid,
sure,
right, and I find that when we're talking with some people and they say, well, Medicare or whatever, we'll take care of my long-term care, and the truth is some people at 55 or 60 or even 65, they're not sure which is which and what's the difference, even though they've sat down with somebody and maybe even done Medicare. Purchased a supplemental plan or something along those lines.
It's hard not to interchange them and get confused.
It is. They're so close. But obviously, when we're thinking about Medicare, that is where people buy supplemental policies for. But Medicaid is really where you've spent down your assets and you really don't have much left at all. And you rely on the government.
So basically, Medicare and Medicaid are both government programs.
Yep.
Okay. So Medicare is age 65, you qualify for the health program for retirees.
Yep.
And there's basically up to 100-day kind of coverage in a care facility that Medicare will provide. Medicaid is when you don't have any money and you're bankrupt, essentially, and the government says we'll start paying the bill.
Yeah. So that means you spent down your 401ks, you spent down the cash that you have in the bank, the CDs, almost all of it's gone.
And you're down to whatever minimums that state and so forth
Sure, and then you each have different ones. And they'll allow the spouse to stay in the home, that type of thing. However, one of the things I really was chatting about with Ben before the show was, and I wasn't talking with you about this, Seth, but one of the things that we're talking about was long-term care is certainly an issue, but it's not necessarily an issue for the person that goes into the home or that needs the health care. The issue is that the healthy spouse, if there's indeed a healthy spouse, is the one that is writing checks constantly and is trying to figure out, well, how do I write a check out for $8,000 a month? And what does that do to my portfolio? And how does that affect my actual income on a regular basis? And can I really afford to do the things that I used to do all the time?
Yes,
as a result.
There's that misnomer, right? People think when you sit down with long-term care, and some long-term care people are trying to sell you this. Trust me. I mean, that happens. Sell you the Ritz-Carlton version or whatever, the Marriott 5-star.
5-star, yes.
5-star, kind of like location to stay. And this is how much coverage you're going to want to enjoy the end years of your life.
Yeah.
Now, in a financial planning scenario where, we're really trying to evaluate, the entire spectrum here, when you buy long-term care, you don't buy it for yourself. You buy it for the healthy spouse. You buy it for the person who's going to be left here after you pass away to make sure that there's enough assets remaining to care for them.
Right. So basically what you're doing through that, and we'll get into the solution-oriented side of this next time, but basically what you're doing is you're protecting a portfolio that you have built for the last 45 to 50 years.
Yeah. And because the thing is I have seen multi-million-dollar portfolios and people who have refused to buy long-term care. And ultimately, they have just,
self-insured.
They said, well, I'm just going to die in my sleep, or this is what's going to happen, and so forth. And I knew a couple had $2 million, second marriage, became very stubborn about long-term care. She wanted it. He said no. And they both went into a care facility, and then it turned out that they couldn't live together because
they both went in.
They both went in.
Wow.
They couldn't live together because of it was like Alzheimer's dementia stuff going on, and he couldn't remember her and thought she was, or vice versa, and just the whole thing fell apart. So they needed 2 rooms, 2 full-time care instead of living together. And
so they basically drained their asset pile pretty fast.
Yeah. Oh, it was down to a few $100,000 when it was all said and done.
Yeah,
and it was horrible. I mean, if you hate to say I told you so, and it doesn't happen to everybody, but some of the solution stuff that has developed because of, like I don't want to spend my money and lose it scenario has really changed in our, our world of the long-term care planning.
We'll definitely get to that.
We'll get into that, and that's going to be exciting.
So Seth, I thought maybe we'd do this. We'd go into and talk a little bit about kind of just so people can get an idea of what it costs, and maybe even think about your state too. So there's an article, Seth, here that talks about a Genworth study. I think it's pretty interesting. It's a 2017 survey there. You want to go into that?
Yeah. Actually, this is probably not as depressing as the the direction that the conversation was taking me. So I was thinking about the personal experiences and some friends, and it really has been sad to have some very close friends, create their own final solution. I'll just say that, because of what they were faced with, and just either the lack of planning or the willingness to do that. And it was I'm going to walk off into the woods solution for them. And that was really sad to hear. And that is a statistic that is climbing among the baby boomer population, which is predominantly what we're talking about here. And another statistic that's hard to really understand or like I just have a hard time grasping is that the baby boomer population that is pushing through, creating this tsunami effect in this environment, is growing. Like, you don't think of a population typically that's at that stage of life growing. And there's a lot of people that are coming to the U.S. that are in this population as well. But it's also one of the largest generations that we have that is pushing through, and it's a supply and demand situation really pushing these numbers here.
Great point.
That is a good point. And I think, thinking about how that is pushing through is really important because, right, we're talking about 30 to 40 million Americans that have just started turning 65 or have turned 65, and there is a massive demand on care facilities. But think about all the people the 80, 90 million who will be turning 65 over the next 20 years.
Yeah.
So if you turn 65 10 years from now, you might not need long-term care for 20 years from then. So that's 30 years from now.
Yeah.
Right? And then vice versa. So, and the growing statistic of 10,000 a day, that number gets larger per day. I mean, over the next
going down.
It's not going down. It's not staying level. It's actually increasing.
Yeah.
And so as you start thinking about that demand, just because they turn 65 doesn't mean they need long-term care now. We have a huge long-term care demand as things grow.
Mm.
Exactly.
Yeah.
So let's talk about what expenses that we're seeing.
I'm getting there.
Okay. All right. I'm chopping
So
on the
between
bit.
2016 and 17, the average cost of a private nursing home home increased 5.5%. Right? That's huge.
That's huge. That's close to college inflation.
And we know that's huge.
Yeah.
From personal experience, we know that's huge. Yeah.
Right. And the average cost of a semi-private nursing home room rose 4.44%, and the average cost of an assisted living facility rose 3.35%. So all across the board, these are increases of costs that are eroding really some of the products that have been used. Genworth, right, one of the largest providers in this in kind of this product of long-term care idea, right, has had to completely rearrange their business model because of some of these numbers and the statistics that they just couldn't fathom, or the statistics or the people that they had working on the numbers behind the scenes weren't able to grasp how these increases were going to impact their product sets and the outlay of dollars that were going to be required.
Sure.
In this stage of life.
Yeah. So looking at New Hampshire, for New Hampshire listeners out there, the average cost is $9,657 a month. So you take that times 12, and you're talking $110,000 a year. And then, Seth, a little bit cheaper where you are, not much, but a little bit, about $8,784 in Oregon. And you know what's funny? Stuff that you had mentioned that hey, it may be different in Portland than it is out in Timbuktu. So I mean, these are all averaged together for the state, so it might be a lot more expensive here in the Portland area. But in going through and taking a look at the different states, there are some states that they're just certainly more than others. And you can see why. Connecticut, Massachusetts, Hawaii, New York, they're all up above $12,000 a year. You know, Alaska, $24,333.
That is unbelievable.
Is that crazy?
Yeah.
I don't know. I don't know what the population in Alaska is exactly. What the growing population. I'm sure it probably follows somewhat of what's going on in the other 49. But to me, wow, it's hard to imagine it's that much. So that's a month, $24,000 a month.
I just found out that my sister and brother-in-law are moving to Alaska.
Oh, are they aging?
Yeah.
Well, I guess we're all aging.
No, well, yes, they are aging, as is everybody.
Yeah.
but they're young. I mean, they're a young family.
Cool.
They're moving from North Dakota to Alaska.
Okay.
Yeah.
Cold to cold.
Yeah, and they just bought a house last year, so I don't know. I don't get it. We're gonna have to talk. I'll get back to you on
too many survival shows on Alaska being watched in that household.
Yeah, no kidding. But there are some states where it's certainly more affordable, and not that it's ever affordable. I don't necessarily think it's so crazy, but
significantly,
it is.
by a lot.
Yeah. So Texas, $4,563 a month. Oklahoma, $4,470. Missouri, $4,912. So there are some states that the care is just a lot more affordable. I was surprised by Illinois being fairly low in the in the top in the bottom 10 there, $5,688. I always think of Illinois as being really expensive, kind of like a Connecticut, Massachusetts type of thing. But yeah, but basically people are facing.
It's like if you make it to the nursing home without getting shot in Chicago.
Yeah. Hey,
honestly, they're like, listen, we're running out of people.
Let me tell you, Ben, there's probably some truth in that. But Ben, you brought up an interesting stat from Genworth that you thought was kind of interesting, and I agree with you on that.
Well, yeah, I mean, basically, they say that 50% of people pay for their long-term care themselves. Is that what you're talking about?
Well, I was actually talking about the stat that was talking about Genworth projecting what's going to happen with the cost of long-term care, because sometimes we think, okay, so it's expensive, but it can't keep on going up. But they're saying this. I think they're getting, maybe the actuarial guys are getting a little smarter here, but they're saying that they believe that the average cost of a semi-private nursing home room will rise 142% over the next 30 years, from $7,148 a month to $17,350. So if we're sitting down at the table in 25, 30 years and around our radio mics here and talking, we would possibly be talking about expenses current day of being around $17,000 to $18,000 a month just for care.
Yeah, and I mean, I think that's where people don't understand. It's like, how do they do this, right? How do I pay, way below that per year, and they provide that benefit to me per month? And it's just how and what insurance and the whole concept works is paying today, they invest the dollars, they handle it, and they create reserves and all that stuff. These are things that people should be planning for, because it's so inexpensive. If you're 45, 50, 55 years old, I mean, like, this stuff is cheap. This is something you could resolve today and solve so many retirement fears.
Sure.
Like, we talk to people, it's like, these insurance companies, there's so many opportunities. And then there's the whole story, and Genworth is well known for this, is the increasing costs.
That is what they're facing. In fact, I just read this, Ben. I don't know if I shared this with you, but they're looking
Probably not. You hold back a lot.
I do. But they're looking at, I just saw an article come out in one of our financial planning magazines. They're talking about the increase on premiums of past policies going up by 58%. Now, they can't just go and say, Seth Krussman, I want to raise your rates. They have to look at, they're very nice, but they say,
but they do.
Yeah, but what they do is they have to go.
They don't
across
say
the
it,
whole
but they
class.
mean it.
Yeah. Well, they say, hey, they have to apply to the state. So in Oregon, they have to apply to the state and say, hey, listen, we need, because of our experiences and how much it's costing our company. And they have the ability to do this because it's written to the policies, but they have to go for a class. And they say, well, for everyone's between the ages of 62 and 67, we want to apply for a premium rate increase. And it can only be so much governed by the state.
Because these are the costs we're experiencing, and we want to make sure that we can provide for those expenses that we, and that exists. And I think that's one of the struggles with traditional long-term care insurance, which is why it has become less and less popular.
Oh, for sure.
The other thing is so that's the number one thing is people are hearing about how these rates are increasing. increasing. And I can't tell you how many people we've sat down with who bought, traditional long-term care from some
John Hancock, MetLife, Genworth.
from some long-term care salesman who sat down, sold them this massive policy. You scared them into buying the Ritz-Carlton version, and then all of a sudden the rates are going up, and they planned on, this budget living in retirement. And they're like, I'm getting a 58% increase in my long-term care costs.
Yeah. So it is significant. Now, if you do have a long-term care policy in place, doesn't mean there's something wrong with that. In fact, I'm thinking of a client that I have right now who's had one for about 18 years, and it looks like they're going to start needing to use this policy here fairly soon. The good thing about their policy is the fact that it's increasing by 5% compounded every year, so it's actually going to take care of them pretty well.
So the daily benefit's increasing.
Yeah. So I think it's going to work out quite well for them. But really, I guess the biggest thing that we want to emphasize today is that the projection of what it's going to cost has a significant impact on retirement and long-term care planning strategies for individuals at any age. So we want to talk about and just spend the last few minutes talking about that retirement planning. If you're doing retirement planning today and you're talking about your 401k, you're talking about making sure you have disability insurance in place. You're talking about making sure that your assets are going to pass on to your kids, that kind of thing. That's really important. But that conversation, if you're 45, 50 years old, 55 years old, your retirement planning conversation with your financial planner should most definitely include what impact will long-term care costs, healthcare costs, have on my portfolio, and how will that affect if I was to go into a home or needed help, someone coming to my house, that money that's going out every single month, how will that impact my retirement? How will that affect my spouse? They're healthy, I'm not. How will it affect them to be able to carry on with their daily living from day to day? And if we're not covering that as financial advisors, we're not covering a part that's very, very important to you.
Yeah. I mean, I've had people totally reject long-term care. Say, I'm not going to buy it.
Yeah.
And I've had people joke around about, I'm going to go out in the woods with a gun. Or this, all the stuff Seth was talking about.
Yeah.
And it's really, actually hearing that stuff is a little frightening on our end. I mean, people joke around about that, but that's really not, But one of the things I wanted to point out, John, as you were talking and kind of going through my mind is like people are concerned about that increasing cost in long-term care that they potentially might have in a retirement period.
Right.
But they also don't want to spend money on something that they think, what happens if I die in my sleep? And I don't need it. And we wasted all this money on it. Yeah. And, one of those statistics is that, basically it's something like if you're married, and...
What, 66% of people over the age of 65 are going to
have some need for care.
Yeah.
And so it's like if you're going to have some need, there's a big deal there. And, so there's that fear of that. So there's been a lot of crafting inside this world in the last few years that has really stretched the envelope of those concerns, which has said, hey, how do we answer those things? And I'm excited to share about those.
That'll be fun next week. So. Well, there's this guy named Bruce Chernoff, who is the president and CEO of a company, of a foundation called the SCAN Foundation. And the SCAN Foundation researches care for older adults. And basically what he says is, if we don't need it ourselves, it is likely that our spouses, our significant other, or our parents will. One way or another, it will touch the lives of every single American. This is not like being struck by lightning. It is something we will all face in our lives, and many Americans have a blind spot when it comes to that cost in the future.
So you said struck by lightning, John, and I actually have a near miss with that. I'm going to share that with you in a little bit, but we're going to be coming back here listening to Money on Tap. You can reach us at 855-226-8551. We're going to be coming back and talking a little bit more about long-term care, and the statistics are overwhelming. This is an eventual event in most people's horizon. You can reach us at 855-226-8551, Money on Tap.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
More Money on Tap in just a moment. Ben, John, and Seth explain why it's important for the investor to beware, even when it sounds legitimate, which was the case with Bernie Madoff and the now well-known Ponzi schemes. That's today on our Cliff Notes edition of Money on Tap, as Ben begins by describing what the fraudulent claim looks like.
Someone's taking your money in, showing you a potential value to your assets in which they are not actually true.
And also, they're saying, hypothetically, we can get you a 15% rate of return guaranteed on a regular basis, and maybe they're going to show you a certificate or something like that.
Yeah, and that's what Bernie Madoff was doing, but he was actually, we don't make the big returns. We just do 8%. And, the banks, everyone was buying into this. He's like, we're not the big, hedge funds. We just do a steady.
So he was selling to investment companies. He was selling to everyone, not your next door neighbor, but he was selling to everyone.
Yeah, big banks, everybody. Yeah. And, a lot of people don't realize that he helped write a lot of, the laws that we actually work under in some capacities in the securities world. So it's interesting that he was involved on that end and knew the fraud, how to do it. The one thing I find about Ponzi schemes is that in a positive market, it's easier to hide.
As returns are, everything's doing well. And
right. It was in the big crashes that Ponzi schemes show their face.
When everything's going well, nobody's paying that close of attention, right? But when they start to see a market correction and investors start to go to, where do I have my money and how do I safeguard some of my money, and start divesting and taking some of that money off the table and putting it into savings accounts or whatever they think is more secure possibly. But anyways, when it starts to unwind, well, then that's when it exposes the Ponzi schemes, because typically the Ponzi schemes are relying on an influx of people putting more money into the program. When it starts to go away, then they have no way of having liquidity. And so they get exposed.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Now, we are talking about long-term care, and the statistics are overwhelming. Like, what was it, 60% of people are going to have some kind of a long-term care event or some kind of a need for this type of planning. We do a lot of this, and it's a conversation that we're consistently having, because that's what we're here to do. We're here to have conversations that, frankly, a lot of people don't want to think about or have. But one that I wanted to share with you, experience before you get going there, Ben, was my near miss with lightning. Now, we don't have a lot of lightning storms here in Oregon, but we were going to church in Corvallis one day, visiting some pastors that had moved on to pastor a church down in Corvallis, where the Oregon State Beavers reside. That's what.
Oh yes, we've all heard of them.
Yes, my wife's. That's where she went to school. Yes. My entire family went to U of O. Ben and I met at Liberty University. We're Flames. So there you go. Anyways, and we're not going to talk about you, John. Okay. We're not going to talk. Bob Jones University.
Yes.
But anyway, so we're getting out of the service there, and there's this terrific, like, thunderstorm, lightning storm going on. And I remember it so well. I'm wearing a pair of Crocs, which I think may have saved my life. Thank you to manufacturer of Crocs. And a lightning
Crocs can take your life too. Just happened in South Carolina yesterday.
Yes,
so
they can.
Anyways,
yeah. A lightning struck, like, it was 100 yards away, but I swear it was 10 feet away.
Oh wow!
And I could feel like I've never felt that kind of electricity before. My voice went from here up there, and I started doing a little dance, folks. It was.
Was this caught on tape? No, okay, okay.
But she was standing
sure we can
under the
believe it.
cover, and I was out in the parking lot trying to get to the car. It was terrifying. I've never experienced anything quite like that.
Okay, well, let's go back to our show as we wrap this thing up here, guys. All
enough
right,
lightning strike stories, Seth.
I think just to bring this down to some conversation. Long-term care, the expectation and cost, is between $100,000 and $140,000 is basically on the high end, right? And you could be at $45,000 to $60,000 on the low end, depending on where things land for you. I think the one thing about planning, and as Seth has mentioned, when we talk to people about trying to figure out long-term care and how this fits for them, it's not a story about, hey, you need to buy long-term care. It's a story of how are we going to solve all of your financial needs, from retirement to care, to death, to estate, to your children, and those pieces. And so when you listen to our shows, I think it's important that you know that this is a segment of a bigger story. Sure. And, for a lot of people, they say to us, I don't want long-term care because I don't want to be in a nursing home. And I get that a lot. And my response,
I'm with them.
my response to them is you may not be able to find that bed, as I had mentioned earlier, because of the demand. But honestly, most care policies that you have out there, they will provide for you to be in your home.
In fact, they're required by law to do that. So they can't just be facility-only programs.
And honestly, for the insurance companies, right, if they're going to say, hey, listen, we're going to give you $300 a day or whatever the thing is, and it only costs you $150 a day to be in your home, well, that potentially, depending on the type of policy, might be less costly to them. So therefore, they're paying out less money.
They'd much rather keep you at home.
They'd much rather keep you at home than get you in a facility. Yeah. So it's a win-win. They want to provide for you what you want the most anyway. So some of this stuff is very flexible on the in-home care. Yeah. And those are the kind of stories we talk about. And I think also having a conversation of, after the first spouse passes away, how is the second spouse cared for? Because a lot of people say to me, well, I'll care for my husband, or my husband will care for me, and then but then who cares for you? And that's a separate conversation.
It's very,
in
very
planning.
taxing to take care of someone, especially as you get up in years and you're trying to take care of someone, trying to lift, trying to shower, all these stuff.
I think there's the other side where there's the assets that people don't necessarily see this happening all the time. But Kira is in real estate, and her partner actually specializes in kind of working with retirees in real estate. And there's a lot of people that they see coming through that are basically a fire sale in their assets, trying to support grandma, grandpa, dad, mom in the in-home care situation. It's the home that they built, they've raised their family in, or maybe they even were raised in. And so there's a lot of ties in there. But to be able to support the in-home care, basically everything in the estate is liquidated or before they even pass away, and they're having to reorient themselves. And it's one thing to think of, hey, how in today's market, it's one thing to try to sell a house, right? It's pretty, it can be done, right? But they don't have the ability to look into the future and say, what's the marketplace going to look like? Are they going to have the ability to sell at a rate that supports, supporting mom and dad in their final years, or themselves in their final years? So
there's a lot here, guys. There's a lot here, and we're probably not even done. But the fact is,
are we done with today?
We are done with today.
I'm not done with you.
I know.
I'm not done with you either, Seth, but sometimes you gotta end.
Well, that's going to do it for us today, at least for this show. Next show, we're going to be talking more about the solutions around long-term care, and we've identified the major issue.
Yeah, and the changes that have created these better solutions as time has gone on, which I'm excited about.
Yeah,
well said. Yeah, so we're going to address some of those in different ways, and we as planners help reduce the risk of the problem going forward. That's a goal for us here. You've been listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap. Make it a great week, folks. We look forward to talking to you here soon. Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps.
Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.